There's a lot of fear about China. This involves Alibaba, which is a very popular stock on this channel. Remember, guys, do not buy any stock because somebody on YouTube likes the stock. You have to create your own process, and that's what we're here to do, to teach a process. China has concerns about Taiwan. There's a lot of rumblings about China invading Taiwan and causing some major war. Is it grounded or ungrounded? I don't know, but these are the factors that do affect stock price. A company like Alibaba had a high of $310 a share and has gotten as low as $58 a share last year. It's now in the 80s, but we're here on this channel to look at the fundamentals, to look at how the company looks in terms of a risk-reward standpoint today based on its intrinsic value. And we're also going to sit there and talk about some of the bull and bear cases. So I encourage you, no matter what level you are in investing, to watch this entire video because we're going to cover everything from the fundamentals to the actual stock price based on our stock analyzer tool and what price should be paid based on the assumptions for the future. So please stay here for the entire video. We're going to recap all of that. One of the big news stories out of Alibaba is they're spinning off their 6 divisions into separate companies. A lot of people think that's going to release a lot of value because that tends to happen in companies. When there's a lot of divisions together that have a lot of good value together, but there's a perceived problem with the company, if they spin it all off, they can get a lot more value. The parts are sometimes worth a lot more than the whole, and that's what people are hoping for here. So let's go check out the company. All right, 2 bull cases before we go forward, and then we'll do bear cases. First off, apart from Amazon, they're the 2nd largest online retailer in the world. Second bull case, they own 51% of e-commerce transactions in China. Guys, China is the world's largest, actually 2nd largest population now because they had a decline last year and India took over. But it's the fastest growing middle class in the world, and they own 51% of those retail. As the middle class grows, as the economy grows in China, I have to think that Alibaba will be a major beneficiary of that growth, and that's really, really important. Okay, now 2 bear cases. First off, poor reputation in the US. Now the good side, if you're an investor, is you look at that poor reputation and probably drives down the stock price. 16 or 18% of people between the ages of 18 and 65 in the US think that Alibaba should be banned in the US. Second bear case. As you guys know, a lot of major companies in the US, Microsoft, Google, Amazon, have major cloud-based growth. In China, for Alibaba, it was only 2%, which was way below what's expected, especially in such a fast-growing, high-margin business area. So there's definitely are concerns. Now, the question is that driven by a looming recession in China? We don't know. But again, our goal as a channel is to look at this company years and years out. If your goal is to buy the company and make a buck in a month or 2, we're not the channel for you. And I'm okay with that. There's other ways to make money in the short run using charts that Mo does that I believe in. But if you're going to look at the fundamentals of the business, you've got to look at the long-term fundamentals. So let's pull it up in our software right now, and we will start looking at some of the major fundamentals of the company. Look at that, guys. All-time high. I was wrong. It was 319 back on October 27th, 2020. So we're 2.5 years later, and we're down. The 52-week low was it just exactly 2 years later. It went from 319 to 58 bucks. That's what happens, guys. All right. It's a $225 billion company. And look at this. The enterprise value is 239. What do these numbers mean? The market cap is 225 billion. If you wanted to buy every share on the market, that's what you pay. Now, if you want to buy the whole company with no debt, net of all cash, you got to pay 239 billion. This will basically show the difference here is basically your debt. This is not a lot of debt for a company that did revenue of 121 billion in the last 1 year. That's incredible. Now, look at this. 5-year profit margin, about 16%. Last year, 8.4%. So the profits have been beaten down a little bit. The question is this temporary? Is this a long-term issue? 5-year PE, 15. 1-year PE of 22. Again, you look at that, probably driven by that profit margin, right? Profit margin has fallen below its 5-year average. That's what makes the PE go up. No dividend and a very crappy return on invested capital. This is a very, very common thing that I talk about, return on invested capital. How much money do they make on the money invested in the business? This, frankly, is I don't like this. However, with that said, they've been bogged down lately with a lot of different, let's look at their income statement, I'll show you. Their profit has fallen quite considerably in the last 2 years, from 20-some billion down to 8 and 10 billion. So the question you have to ask yourself is, does that return on invested capital really reflect the abilities of the business? Are they going to get back to their previous levels? That's the question. They've already rebounded off their low right here. Hopefully that's sustainable. But you go back up here to their revenue, and it was growing quite steadily for quite a bit of time. Look at this. 52, 71, 100, flossing, 119, and then a little bit of a slowdown there. So you need to determine for yourself if you think this is a temporary problem or a long-term problem. Remember, go look at any company you love. They're going to have ups and downs in their revenue growth, unless it's Apple for the last 20 years. But Apple will eventually get to the point where they're not growing a ton. That's just the way it is, the bigger and bigger you get. The question is, does Alibaba have more potential because it's in a market that's fast growing with a fast growing economy? That's the big key there. Don't be afraid that China will be a bigger economy than us very soon. That's not a bad thing. That is not a bad thing at all. All right, let's check out the 8 pillars here. Now, for those of you who belong to our software, remember, you can do your custom 8 pillars, but you can do up to 12 pillars. And there's literally I think the calculation was like 4 quadrillion different variations. But it's not great here. We have 3 X's, but look at these ones. The 5-year PE and the 5-year price to free cash flow, 11 and 15. That's what gets me excited. I look at this going, damn, I can pay 11 times free cash flow over the last 5 years for a company that still has a lot of growth potential. A lot of growth potential still. Look at a company like Apple without a lot of growth potential. And let's look at their 5-year PE, 34. That's what I mean. I look at this going, wait a second. So the question you have to ask yourself, is the stock price really reflecting the future of the business, or is it reflecting the short-term concerns about China and all the perceptions about Alibaba as a Chinese company? That's the question you need to ask yourself. Now, what are the analysts doing right now? What are they saying about Alibaba? So for this company that's down 80%, they're expected to make $7.64 from this last March in earnings per share, almost doubling over the next 4 or 5 years. All right, it's not a huge growth, but you look at this going, okay, it's pretty much double-digit growth every year. Not bad. Now remember, these are analysts. I take them with a grain of salt. They have career risk. They need to make sure that they're all around the same numbers, or else they will get beaten up if they're wrong. So just remember that. But it's nice to take a look and see what analysts are saying. Let's check out their revenue growth numbers. Basically 10% a year. Look at this. Basically 10% per year. And this is why we have this on our software. We don't have it because we sit there. It's just nice to get an idea of what others are saying out there. And I look at this going, oh, for a company that's dying, that's not bad in terms of revenue growth, okay? And the analysts, as you can see, as they go up further, less and less. And as we go up further, the more recent numbers will start increasing. So as you can see so far, guys, there's a lot of perception about Alibaba. It's been very big in showing the stock price. I mean, look at this. Look at the stock over the last 1 year. It's down 12% over the last 1 year. It's down 7.6% in the last 10 years. So 10 years ago, it is 7.6% below the price it was 10 years ago. Actually, was it 10 years ago? Yeah. September of 2014, almost 10 years ago. But look at their revenue. 7.3 billion versus 122 billion. And they're buying back shares now. Why? Because they're smart and they realize their stock is cheap. We love the fact that they're buying back shares when their stock is cheap. That's a big thing for us. Overall, in the last 5 years, the shares outstanding are up, according to our 8 pillars. But if you go to the income statement at the very bottom, here's what it shows. They're buying back shares. 2.71, 2.68, 2.58. And that's a part of their future. And we want companies buying back cheap shares. They're investing your money at higher rates of return. So I guess it drives the next question. What is a reasonable price for Alibaba? Now, before I do this, I'm going to go in our stock analyzer tool. This software is available to everybody at everythingmoney.com. We're running a special, $7 for 7 days. You get everything you've seen so far, including all the tools up here. And most importantly, our community of investors, thousands of people in there that you can talk to every single day about your investing ideas. Because investing is a lonely road. I imagine you're probably out there going, yeah, I talk to my idiot friends, but they just want to buy all the hype. Great. This is for you. Now, we're going to do the stock analyzer tool. Now, I want to make sure you do one thing. Follow me. Don't leave the video after the stock analyzer tool is done. And here's why. We will show you how to make money while waiting for the stock to go to a price you want it to go to. a lot of money I make is by sitting there and just selling options, selling cash secured puts, which allows me to buy a stock, be paid to wait for the stock to fall to a price I want to buy it at. All right, guys. So here is our stock analyzer tool. Now, guys, look at this. The ROIC over the last 10 years has been 10%. 5 years, 5.7, 1 year, 6.3. So it's going back up again, but you can see they did have a higher ROIC. Now, revenue growth. I want to make low, middle, and high assumptions. And I'm doing a 10-year analysis here. And on our software, you can do anywhere between 1 and 20-year analysis. So I'm going to go conservative and call it 3, 7, and 11% revenue growth. Okay? Because if you saw the analysts, they're expecting 10% a year for the next 5, 6 years, whatever the number of years was. Let's do a low number. Like, come on, they got to hit 3. Let's do a high number. Let's see if they can get 11 for 10 more years. And then probably somewhere in the middle. Now, profit margin. As you can tell, their profit margin has been hurt over the last 10 years. So it started, the 10-year average is 19, the 5-year average is 15.7, and last year was 8.4. It's probably not going to be 8.4 is my guess. So I'm going to go low side with 12, 16, and 20%. Because if they do more, as they grow further with a gross margin that's over 30%, they should be able to drive up their profit margin. And I'm like, okay, let's see if they really crush it and they get 20% profit margin. Now, free cash flow. Look at how different the free cash flow is from the net income. Now, guys, if you're new to the channel, this to me is a positive sign. Remember, net income, which is based on profit margin, can be affected by accounting rules, SEC rules, all these different rules. Free cash flow is much harder to fake. So when the free cash flow is higher than earnings, I like it. I get concerned when it's flipped. That would be my concern, but I'm happy to see this here. And look, the free cash flow is very consistent. At the end of the day, every investment is the present value of all future cash flow. The free cash flow is high here. I love that. In fact, it tells me that I'm probably being way too conservative in my profit margin. Way, way too conservative. Because the free cash flow will eventually come to fruition. So, let's do 20, 23, and 26% free cash flow. So all I did was look at this and saying, okay, they've been pretty consistent. Let's say they just do a crappy job, they get 20. Let's say they do a decent job and get 23, which would be below their 10-year average. And let's say they do a great job and they beat their 10-year average and get 26. That is why I picked those numbers. What you pick is up to you. It's not, that's the reason to have the community here. I see a lot of messages in there saying, hey, do these assumptions make sense? I sometimes respond to them, and other people respond all the time. That's a big reason for the community. I've seen some people go in and I go, whoa, your assumptions I think are too conservative. Other ones I'm like, whoa, what are you doing? You can't expect 20% growth for 20 years. So it's all about making those comments and engaging in that community. Now for PE and price to free cash flow. The current PE is 22. The current price of free cash flow is 8. The question is, what should a company like this, what multiple should it sell for? The larger the growth rate and the larger the return on invested capital, the more premium to the earnings and free cash flow. But this is a very subjective part. Historical average is 15 or 16 for these two metrics. So I usually start at those numbers for growing companies and I go up from there. I'm gonna do 15, 18, and 21. Okay. Again, you can put whatever you want in. I know people who put 13, 15, and 17, or some people will say 10, 12, and 14 because they just want to be really conservative. Whatever. This is the art of investing. But for our final metric, desired annual return, this is your margin of safety. The larger your assumptions, the less likely they're to happen. So you want to put a higher and higher return. Now, it's China. I acknowledge there's a lot of risks involved. For a large company in the US that I've been conservative on, I might put 10% in here, but it's China. So I'm going to go higher. I'm going to go 12, 14, and 16%. These are very high numbers. So I'm going to hit the analyze button. It's going to spit out numbers for me. And the other thing it's going to do is it's going to show me that based on each level here, if I bought it for today's price, what I could expect my return to be based on a net present value of what the stock is today. So I'll explain that to you once we see it. So remember, guys, stick with us past this part because I'm going to show you how to make money waiting for the stock to fall to the level you want it to fall to. Analyze button, boom. All right, we got a low price of 70, a high price of 250, and somewhere in the middle of 120. So what this says, guys, if you paid today's price on the company, you're going to make about a 17% return if the lowest part happens. 25% in the middle, 33 on the high side. So if all the high numbers happen you bought today, you're expected to make about a 33% return. That's a huge number. But again, you're going to have to deal with a lot of volatility, and it is China. So you have to remember that. This isn't a slam dunk. And don't buy it just because of these numbers. You have to understand the country, the company, and you shouldn't just copy anybody. All right, guys, so the stock is currently selling at about $87. Now, let's go out to this Friday. Let's say you wanted the company this Friday, $85. Somebody's willing to pay you 92 cents to get that company on Friday for $85. All right? That's a huge, you're getting almost $1 to wait 5 days on an $80 company, $85 company. That's a huge number. Let's say you don't want it this Friday. Let's say you want to wait 33 days. Go out to July 14th and you want it for $80. Now, somebody's going to pay you $1.35 for every share. That $1.35 divided by $80 strike price is, what is that, 1.6% over 33 days, which is roughly 20% return. You're getting 20% return on your cash to wait 1 month for if you did this over and over and over again and never got your shares, you'd still make 20% return on your money. That is the benefit of this whole entire channel. We show you how to get paid to wait for a stock to hit your price. So guys, everythingmoney.com, $1 per day for 7 days. Try it out. Thank you very much for your time.